So what is infinite banking? Here are the commonly asked questions on this life-changing concept. Now, by the end, you will either be a pro or at least a little bit more educated than when you started, okay? First, I'm gonna describe what is infinite banking, because if you haven't heard of this concept, you might say, is this something I'm doing with a bank? Or am I becoming a bank? Not exactly. Infinite banking is a concept that's been taught by a guy named Nelson Nash, which is using whole life insurance as a savings vehicle to create more leverage in your life. Now, many people don't realize life insurance can actually become a life benefit. Usually, people use it for death benefit, right? You die, your family gets paid. You get squat because, well, you get buried, but your family gets paid, you don't. That's how most people see life insurance, like term life insurance. Whole life is a little bit different. It does have a death benefit, but it also has a cash value component. Ultimately, it has this tax-free, supercharged savings account that you can use. Why is it supercharged? Because it makes more than 0.0% like you get at the bank, but it's tax-free. Oh, by the way, protected from creditors, lawsuits, all that kind of good stuff, right? So that's what that is. So infinite banking is really about using this money to create leverage in life, whether you're using it for retirement or, like we like to recommend, how you can even use it to invest with it and double dip your money, meaning you can make money in two places at the same time. Now, I'm not gonna go into a lot of details with this, but I wanna go more to those commonly asked questions, because many people, if you're already watching this video, you might already be going down this little rabbit hole, okay? So first, who's it good for, right? Just when I say that, I think of like, war, what is it good for? Infinite banking, who is it good for? Absolutely nobody. That's not true.
What is it good for?
Absolutely no.
It's actually good for a lot of you, okay? Well, who's it good for? Those of you in great health, much better. Now, someone will say, am I too old? Well, too old, but I would say if you're over the age of 70, maybe so, okay? But if you're in decent health and you're in your 60s or younger, it's great. It can work great. If you're a non-smoker, it's also a great strategy you can use. Now, who's it not good for? It's definitely not good for those that are smokers, in bad health, someone who's living paycheck to paycheck. You do not want to be putting your money into this, okay? You do not want to be putting your money when you don't have the money to put in. That's where you'll buy cheap term insurance temporarily. By the way, bonus tip, buy convertible term insurance that can convert to whole life without you having to qualify your health again. So if anything happens to your health in the meantime, you're good, okay? So that's who it's good for. It's great for those people that are already saving money. I would say, really leading to point number 2 is how much can you put in? I would recommend if you're gonna be saving at least $5,000 a year into anything, this can be an amazing tool to use. Now, when people ask me how much can I put in, the truth is that you can put in up to 25% of your stated gross annual income, all right? That's generally true. Every company has their own different rules, but for the most part, they don't want you putting in more than 25% of your gross income. So if you make $100,000 a year, the max you can put in is $25,000 a year. If you try to put in more, they're gonna try to stop you. Despite common belief, insurance companies actually don't want you to put and buy too much of this insurance. In fact, I just read an article recently that the largest life insurance policy that was on an unnamed billionaire, multi-billionaire, it was $900 million between multiple life insurance companies. So just so you know, they'll never let you be overinsured, okay? They never want you putting in too much or doing too much because they don't want to go broke if you do it wrong or something goes wrong. So how much can you put in? Up to 25% of your income. Now, here's what's different though with how we do it. When we use our max ROI Infinite Banking, we create a range. See, understand, if you get the traditional whole life policies, this is not a good thing. Traditional whole life, the maximum is also the minimum. So if you say you're trying to put in $25,000 a year, if you can't keep putting in $25,000 a year into those traditional whole life policies, you will lose it. This happened to me over 15 years ago when I bought my first policy. I bought it from a friend, I trusted him. He said, Chris, put in $12,000 a year, it'll be great. Well, guess what? 3 years into it, the recession hit me hard. I didn't have enough money at all. Unfortunately, all of it was going towards insurance costs and commissions to pay him. So after I put in $25,000 into that plan, I couldn't make any more payments. There was no cash value. There was none of that tax-free savings account that had money that we can draft from to pay the premium. It was gone. I lost it all. The worst decision ever. But when we do this max ROI type of infinite banking, it's done differently. See, if your maximum is $25,000 a year that you can put in, well, guess what? That's not the required premium like most policies are. It's actually the maximum they'll let you put it in. The way we design it, you can always pay less, but you can never pay more. So the minimum on that $25,000 is usually between about $5,000 to $6,000. So even if you say, Chris, this year we can't do 25,000, we can only do 10. Great, because that's more than the 5 or 6,000 that you need. By the way, here's another cool thing. The worst case scenario is you can't pay anything into it. Well, because the way we design it, you have cash in there from day one. Worst case scenario, you borrow from the policy to pay your premium the next year. So you actually have more money. It's really hard to let these things blow up on you if you design them right. Unfortunately, most insurance agents don't do it this way, so you gotta be aware of this if you're looking into infinite banking, especially with these other insurance agents and companies that are out there, okay? So how much can you put in? Almost as much as you want, okay? I have one client that actually is a real estate investor, and he's put in over $250,000 a year. I have another client that's put in over $500,000 a year. You could put in tons. None of this Roth IRA rules of you can only put in $6,000 a year and that's it. Well, if you watch one of my other videos, you'll realize if you want $100,000 a year lifestyle, you gotta be saving like $100,000 a year, and you can't do that in Roth IRAs. So here is actually one of those places you can actually save a ton of money and use it to invest too. All right, that comes to this next point. How can you use it? All right. Now, of course, you can use it as a death benefit. That's great. For most of our clients, that's kind of the icing on the cake too. But the cash value is the thing that people always ask, well, what can I do to use this? Well, one, you can just let it accumulate and save. It'll grow maybe 4 or 5% tax-free. Just so you know, if you're in a high tax bracket like I am, right, where you might make a lot of money, this is very important. Because when you factor in taxes, this is like you making at least 7 or 8% rate of return on your money if it were taxable, like in an IRA. Which, by the way, that's about what the stock market makes. But you don't have to deal with all the bipolar nature of the stock market. It's actually just in there, guaranteed. So this money is guaranteed in there. You can pull out however you want. Now, you can use it not just long term for retirement, you can also use it shorter term, especially with the way we design it. You can start using it within the first year. How do you use it? Well, the truth is you can use it for whatever the heck you want, okay? You can actually pull this money out, you can withdraw it, or you can borrow. You can actually get a loan against it. Now, here's a common myth. A lot of people say, well, I borrow from myself, right? But then the question people always say is, wait a minute, why would I pay interest to borrow from myself? Great question. Well, the reason is because you're not borrowing from yourself. That's a myth that everybody tells you. Here's what happens. You've got this savings in here. Let's just say you saved up $100,000 inside this life insurance policy, okay? Now this $100,000, you can just withdraw it like a savings account. That is an option. But if you withdraw it, you now don't earn interest on it anymore. Just like if you withdraw from a savings account, the balance goes down, you earn less interest, right? Same thing in your life insurance. But if you want to keep that interest earning, that $100,000, what you can do is you can get a line of credit against it, whether it be through a bank or just through the insurance company. Just so you know, when you borrow, when you get a line of credit from these policies, if it's through the insurance company, you can pay it back however, whenever you want. The deadline is your death. So the cool thing is they don't charge you monthly payments. They do charge you interest, but you're not paying monthly payments on this. So what happens is that you could let this thing grow and you can actually let it compound against you if you want. Don't recommend it. You can let it compound against you until you die and then let the death benefit pay it off. Then the rest of the death benefit pays to your heirs tax-free. But the cool thing is this, is that say you borrow $50,000 from the insurance company. They are charging you interest, but you're also earning interest on this full $100,000. So what happens, you earn more interest here than you pay on interest here. So you make interest, you make the spread, right? You make more interest in this account. But what if you took that money and instead of just blowing it in Vegas, right? You took that money and used it to invest. Maybe you bought a real estate property and say that real estate property was making you 10% a year. Well, if this is making you 2% a year, you add that to your 10% a year, right? Because you're making more interest than you are from the loan that you're paying on the interest. Guess what? You now are making 12% a year total on your money versus just the usual 10% if you just use your checking or savings account. That's why you get to double dip. You get your money to work in two places at the same time. That's one of the cool ways you can use it. Now, I'm not gonna go into a whole lot of detail on this because we can go a whole another rabbit hole on that, right? But that's essentially what you can use it for. You can use it for whatever you want. You can use it in business. And if you use it in business, you can write off the interest. I have people doing that all the time. You can also use it like Walt Disney did. Did you know that Walt Disney actually started Disney World using his life insurance cash value? The banks didn't want to give him money. They said, listen, you're buying the swampland in Florida. Why would anybody do that? And he said, well, I want to because I see the vision, right? He was a visionary. They said, listen, you need to put up your own money before we even want to put our own money in. He said, all right, well, I got money in my life insurance policy. How's that? They said, perfect. That's guaranteed to be used. Let's do it. They did it. Worked like wonders. I had another client out in Minnesota, out in Minnesota, where he was able to take that money and have that as a line of credit for the bank. He used it as collateral for the bank. They didn't pull it out. They left it there. It was still earning interest, but they used it as collateral, as safety for when he bought a building for him to work his business out of. Well, he bought that building. He did a whole bunch of stuff. He got a very low payment, by the way. The bank gave him a really great interest rate. They lowered it by 2% from the normal interest rate because that collateral was there. So he got a low interest rate, low payment. He built the building, started renting it out, and the renters were paying the building payment for him. And then he went back to the bank and says, hey, listen, the building's paying for itself. Can we take the lien off my life insurance? They said, yes. And they did, and he still has that low payment to this day. So why do people hate him so much? It's because they don't understand. Most of the time, it's like what I said before. The kind of policy I bought early on, which was a big fat waste of money. Do not buy those policies. That's why people hate them so much, all right? We're not talking about those kind of policies. We're using these differently. Now, how do you know if you're getting the right policy? The truth is, you really have to find somebody you trust to really look at it. I recommend shopping around. In fact, use us. Let us compare. We can do apples to apples comparison with anything you're looking at right now, and we'll give you an honest opinion. If somebody will beat us, we'll do it. We'll say, great, go to them. The truth is, nobody's really beating us, okay? I've yet to see somebody beat us legitimately. So if you want to know if you're getting the right policy, reach out to us at moneyripples.com. By the way, if you want to know how to buy a car using infinite banking, check out our next video right now.